Hello everyone, welcome to my channel DevTech Finance. This is my second video on corporate finance where I would be talking about the periodic return. What we observed in our last video in corporate finance was that when we are going to invest in a financial asset, we have to evaluate that asset and we evaluate on the basis of return and on the basis of risk because both the risk and return factor is equally important. So if you are making an investment in any financial asset, you ought to know how much return it would give after a certain period of time and how much risk is involved in it. So we would see three methods to calculate the return, that is the periodic return, arithmetic mean return and geometric mean return. And to calculate risk, we would observe the methods like standard deviation and beta, where standard deviation would tell us about the individual risk involved in the asset and the beta value would give us a proper risk evaluation in terms of the market as well as the risk involved in that financial asset. So it would give a coordination of both the figures. So let's get started with our periodic return. So what exactly periodic return is? It is the return from investment in financial asset over a period of time. So, you have invested in any kind of asset, whether in bonds, whether in equity. So, the return which you would be getting out of it after the time period for which you have invested, say for 1 year, 2 year, 5 years, whatever time period for which you have invested in that asset, after that time period is over, whatever return you would be getting out of it, whether in the form of the capital gain or in the form of any cash flow, all those returns would be considered as the periodic return. Now I would try to make you understand how the return could be in form of capital gain or how the return could be in form of cash flows. So just imagine like the share which you bought at the price of rupees 10. Now the price after the time period for which you have bought that share has been increased, say for after 3 years it has increased to rupees 15. So the rise in price, it is about rupees 5. So that rupees 5 is your capital gain. Why is that capital gain occurring? This is occurring because of the increase in the market price of the financial asset in which you invested. And say like when you would be selling your share or when the time period is over, you would be getting a dividend of rupees 2. So what that dividend would be considered as? That dividend would be considered as the cash flows. So if the coupons are paid on bond and if the dividends are paid on share or whether you are having preference shares or equity shares, whatever is being paid to you as a cash, that is considered as the cash flow for you. But whatever you gain in the term of the market price increase or market price decrease, that is considered as capital gain or capital loss. So periodic return would combine all these things, whether the cash flows, whether the capital gain, all that benefits which you would be getting after the investment in a particular financial asset, all that benefits would be considered as your periodic return for that time period for which you invested. Now the characteristics of the periodic return. So total return on an investment is considered including the price changes as well as the cash flows during the period. Like I said, the price must be expressed in the same currency to measure the accurate value. So just imagine if you wanted to consider prices of the same financial assets in 2 to 3 countries, like in the Spain market or in the Indian market or in the US market, you wanted to consider the price. So how would you do that? If the currencies are different, you won't get the accurate value. So whether you are calculating the returns from different markets, you have to calculate that in the same currency so that it provides you an accurate measure of the returns. Same denomination would also help in comparison of returns from different markets of countries. So this is what I said. Now here's an example of how to calculate the periodic return. So it's a very simple example to just give you a gist on how it is done. So consider a share whose price at the beginning when purchased was $60, while at the end of the year it raised to $65 and $3 was paid as dividend. So a share which you bought at $60. Now you kept that share for 1 year of time, and after that you find that the market price of your share has increased. It has increased to $65. So you are gaining like what I said as capital gain. You are gaining $5, and $3 was paid you as dividend as promised. So $3 is what you get as reward of buying that share. Now, what would be your periodic return for that year? It would be calculated as the change in price plus cash flow divided by price at the beginning. So it's just the change, whatever gain you are having. That's why we are considering it, we are dividing it by price at the beginning. So at the beginning you were having $60. After that there was a change in price of $5, plus you got a cash flow in the form of dividend of $3. Thus, your periodic return was 0.1333, or you can say 13.33%. So this was the return percent which you get after 1 year. So it's a very simple method to calculate the return percent which you get. Just you have to know the change in the price, whether it is occurring or not, whether it is increasing or decreasing, whatever cash flows you are getting, and what was the price at the beginning. Thank you all for watching. I hope you like my video. Do like and share my videos. Subscribe to my channel DevTech Finance, and to keep on track on their corporate finance videos, do look out for my other videos as well, my upcoming videos. Thank you so much.